Trade limitless on HMX, the next-gen decentralized perpetual exchange. Trade crypto, FX, commodities with up to 1000x leverage on the Arbitrum network. Benefit from low fees, multi-asset collateral support, and cross-margin flexibility. Check them out.
From meme to utility, Floki has it all. NFT metaverse game called Valhalla. Floki University, DeFi, charity, and shopping. Floki is governed by the people, for the people. Floki, together there is no stopping us.
Welcome, welcome, welcome. This is Adrian Zdunchik, CMT Charter Market Technician. Some people call me CryptoVerb, and it's actually, a great opportunity to meet today because it's a free trading congress, our 5th edition of the free trading congress. It's sort of like a virtual trade camp the last 7 days that everybody can actually come and pick up a lot of valuable, reliable, accredited license information, not the squiggle lines that you see all over the Twitter, not the fake Fugazi and all those scams attempts and trying to put their desires and hopes into the charts. We are talking about credible analysis. We are talking about credible knowledge. The thing that is missing so much in the crypto scene, and you're in the right place because I'm joined by the excellent professional in this space, probably the best pattern recognition chartist, market technician, if you will, accredited market technician that I've ever got to see around for. And ladies and gentlemen, please welcome Aksel Kibar, CMT. How's it going, Aksel? How are you feeling?
Thanks, Adrian. Thanks for the introduction. I'm good. Yourself? I hope you guys are having a good congress and everything is well on your side.
That's right. Thank you so much, Aksel. And it's always a pleasure to talk to you. Always, it feels like, time flies so fast. And I was speaking to a couple of our also mutual friends that we have also on the follower list. The small world. World is pretty small, and time flies so fast. And with some of them, with like Julius the Kempenauer, right, for the RRG relative rotation graphs, I spoke with him earlier. I think it might have been in February or March. Right, February, March, and it feels like the time is going in no time. And exactly the same, I had this feeling with you, Aksel. Right? Do you remember when was the last time we actually met? The latest time?
Not able to. Few years back, I would say it's fast-moving time. Yeah.
See, that's exactly what I'm saying, right? It's so hard to actually timestamp this because it flies so fast. It's incredible. Yeah. Still, I appreciate that you're finding time, right? Because we, ladies and gentlemen, are gonna have this excellent opportunity to learn from the world-class professional, and I really mean it when in terms of the pattern recognition and building trading systems, statistics, the actual knowledge and substance that it can make you basically give you a chance for profitable trading using chart patterns. There is no other better person on this very planet in 2023 that I'm aware of other than Aksel Kibar. And having so much of the patience, Aksel, that you've always have with my silly questions, please excuse them in advance. And if you don't mind, let's actually jump in straightforward to the very foundations, right? I see you've prepared this excellent, catchy presentation called Tech Charts: Demystifying the World of Classical Charting. Would you like to share a couple of points about that, please?
Yeah, let me quickly start. There's a good amount of material that I want to cover. So first of all, let me tell you guys what I've been doing over the past 6 to 7 years. My main focus has been on global equity markets, but on the side, I'm also looking and I'm interested in the crypto world as well. So I'm applying classical charting principles to a vast majority of instruments, including cryptocurrencies as well. So this is one of the questions that I've been getting lately, that is classical charting applicable to crypto markets? And my answer is going to be yes, and you're going to see some of the examples that I've shared with my audience at TechCharts. Now, over the 6 to 7 years, from the time we have launched the TechCharts membership service, which covers global equities, I have compiled a good amount of trading signals and breakout ideas, and I call these chart pattern reliability and statistics. And I want to quickly share this because there is some kind of an edge you can find in those classical chart pattern completions. Now, the table at the top is from the time we launched, May 2017, till November 2023, covering this period. Over 1,453 chart patterns have completed that I have identified in real time and shared with our audience members. Out of those, 854 of them reached their price targets. Okay, so I have categorized them into 8 different classical chart patterns. Now, if you look at a book that studies classical chart patterns, you will see many derivatives of those that I'm discussing on this slide. But these are the really basic ones. For example, a rising wedge, falling wedge, rounding bottom, all are derivatives of different type of classical chart patterns that are discussed here. A wedge would be some kind of a diagonal pattern like a symmetrical triangle, or a rounding bottom would be a double top, double bottom, or a rectangle. So it would be a variation. So what I have done is not to complicate things too much. I have focused on the major 8. And you can see from here that rectangle, I'm looking at the top table here, rectangle has been the most successful, and in terms of occurrence, the most identified one. So I would say in terms of frequency and the success rate, it's one of the most robust classical chart pattern that I have been trading, and I have been also featuring for our members. Now, followed by a rectangle, head and shoulder continuation, and then the ascending triangle, and then cupped handle, and the list goes on. And all this gives us a success rate over the past 6 to 7 years, close to 60%, 58.8%. Obviously, you want to be above this 58.8, and you can see that there are 2 chart patterns that flash here is the rectangle and head and shoulder continuation. Now, these type 1, type 2, type 3, type 4, I'm going to discuss those. But before I discuss those, I want to look at the year-to-date number. Now, we know that in global equities, it's been a challenging year so far because of the ups and downs. With classical chart patterns, especially the breakout strategies, we want trends, we want directional movements. And it can be a little bit challenging when the market moves in a sideways range, or even sometimes in a corrective period where not much trends are visible. So even though this has been a little bit challenging year, we've started seeing some pickup in the success rate to 55.6. You can see that we're still below the 7-year average. But something that I want to again draw your attention is the success rate of rectangle. Even in a challenging market environment like this, we are at 65.5%, even better than the success rate over the 7 years. So the next one is in terms of frequency. Obviously, it's been less frequent, visible ascending triangle. 21 occurrences this year, 14 of them were successful, and we are at a 66.7% rate, which is clearly above the 7-year average. So these 2 are the stars of 2023. We are sitting at 55.6% success rate. But now, let's see what this type 1, type 2, type 3, and type 4 are for the audience who are not familiar with this work. Now, for example, this is a slide that shows a breakout from a symmetrical triangle chart pattern. And the two books that I've been following is Edwards and Magee and Richard Schabacker. Those are, for me, the Bibles of classical charting principles. And in Edwards and Magee, it says that you need a breakout confirmation level. So what level is a breakout confirmation? Now, this changes for everyone, okay? Edwards and Magee took 3% breakout confirmation as a guideline, meaning the stock or the price of that instrument needs to close 3% above that resistance level that you have identified. So in this case, 13.9 is the resistance. At 3%, the minute that the stock closes 3% above that threshold, which is the gray dotted line, we consider that as a breakout confirmation. Now, this can be a little bit wide for FX. In those cases, a 1% move or 0.5% move would be enough. Or you can take an ATR, a certain level of an ATR as a breakout confirmation. But what I'm taking is the Edwards and Magee 3% guideline as a breakout confirmation. And then we also place a chart pattern negation level. We say that this is a subjective level inside the pattern, a minor law, that if the stock fails towards the pattern boundary and reaches that level, we say that this is not a symmetrical triangle anymore. Or in the case of a rectangle, a minor law inside the pattern would say that, okay, this rectangle is not a rectangle, so this must be morphing into some other chart pattern configuration. So we start monitoring it accordingly. And we assume that the pattern has failed, okay? So when the pattern fails by reaching chart pattern negation, it's considered as type 4 breakout, which means failed breakouts. Now, you can see that over the past 7 years, 41.2% of those were failures. Now, the rest was piled up in type 1, type 2, and type 3 breakouts. Now, I'm going to discuss what these mean. Okay, so type 1 breakout. Because it is difficult to cater everyone's risk profile, okay, I said that a stop loss should be placed below the chart pattern boundary. Now, how tight you place that stop loss will depend on your risk profile. Now, what I have observed with those breakouts is that some of those breakouts break out and rally to the price objective. So if you're placing a very tight stop loss below the chart pattern boundary, it's not even challenged. So if you size the position, okay, aggressively, that means those will not get triggered. And the price immediately reaches the price target. So these are considered type 1 breakouts. Now let's go and check the type 1 breakouts. Type 1 breakouts over the past 7 years have constituted about 26.8% of the breakouts. So that means 26.8% of those signals actually broke out and rallied to the price target. Now, a common question that I get is, okay, fine, the stock breaks out and rallies to the price target, but what if we wait for a pullback? That I categorize it as type 2 breakout. So if you're actually waiting for a pullback, type 2 breakouts are those that pull back to the pattern boundary, but also do not challenge the pattern boundary by breaching that boundary on the downside. Which means, again, if you have a stop loss, which is a tight stop loss below the pattern boundary, again, it is not triggered during this breakout and rally. Now, you want to wait for a pullback, fine, but then you're losing out the opportunity to be involved in 26.8% of the strong breakout moves. You're left with 20% of them. As you can see, type 1 versus type 2, there are less opportunities or less of those that actually are successful compared to the 26.8%. So you're giving up on those basically. That's why Richard Schabacker in his book is saying that the best breakout takes place at the time of the breakout. So the best entry condition is the minute that you see the breakout on your chart. So if you are actually targeting those, then you will be able to capitalize on type 1 and type 2. So you're not basically missing out on the type 1 breakouts. And something else that I have figured out over the years is when it is a type 1 breakout, it is so powerful that even though you're initially calculating your stop loss and sizing according to the price target, those type 1 breakouts usually exceed the price objective. So they have so much momentum in them that the minute that you reach the price target in a couple of days, in few days, you can easily step back and say, okay, I'll take a partial profit here because this looks like a type 1 breakout and I will ride the rest. So that immediately improves your risk reward as you're riding those breakouts. So the advantage of being involved in type 1 breakouts, which comes with acting at the time of the breakout, is the advantage of having a much better reward to risk as the trend pushes past the rectangle price target or the chart pattern price objective. Now we're going to discuss type 3 breakout. Now this is an interesting one. Type 3 breakout are those that gets you triggered, gets your stop loss triggered if you have it really tight. Okay, so in this case, for example, the chart pattern negation would be at this low. The rectangle will still be valid even after a pullback like this, but if you have it very tight, the stop loss, your stop loss will get triggered. In that case, you need a re-entry strategy. You would either say, I will skip no matter what when I get stopped out, which means you will be working with 46.7% success rate because type 1 and type 2, the basket of type 1 and type 2 are a total of 46.67% success rate, which means if you're targeting a reward to risk of 3 to 1 or 2.5 to 1, you have a great edge here. But if you say that, okay, I'm going to be involved in type 3 breakouts, 12% of them were type 3 over the 7 years period. So those require a re-entry strategy, which means if you get stopped out, once the momentum picks up again and the stock or the price starts moving in the direction of the initial breakout, you have to initiate a re-entry strategy trying to capture the remaining part. So this is type 3. Type 4 is straight away failure, directly going to the chart pattern negation level, not even recovering for a type 3 condition. So these are the type 4 breakouts. And when you look at the statistics, you can study it later on, and you will be able to see that the best way, again, to act is the minute that the breakout takes place, even if you're placing a tight stop loss and you get triggered, those stop losses get triggered, imagining that you don't get involved one more time in type 3 breakouts, you're basically working with a 46.7% success rate for these chart patterns. Now, if you look at the rectangle, obviously type 1 and type 2 are much higher, which gives you a much sweet spot to deal with if you're looking at rectangles only. So you can make it your strategy that I will only take rectangles, and you will have a nice edge with classical charting. Okay, these are the 8 classical chart patterns: 1, 2, 3, 4, 5, 6, 7, 8. Head and shoulder continuation, symmetrical triangle, head and shoulder bottom, head and shoulder top, descending triangle, ascending cup with handle, and rectangle. One thing that you will recognize here is that, which I pay a lot of attention, is I want to make sure that chart patterns have horizontal boundaries and they have minimum 3 tests before a breakout takes place. So, for example, ascending triangle with its horizontal boundary, descending triangle, cup with handle, rectangle, head and shoulder bottom, head and shoulder continuation. The only different one, which has diagonal boundary, is the symmetrical triangle. So with symmetrical triangle, my concern is that usually those type of consolidations are low volatility periods. So a breakout takes place and you want the price to run. If the price is not going to be able to run, it's going to lose momentum. And the easy way to do that is with a symmetrical triangle, because it has so many minor resistances that price can find resistance and lose that momentum. You want to capture a directional movement, so you want all the previous highs to be breached at the same time of the breakout taking place. Now, these are two must-have books in your library. One of them is Richard Schabacker on the left-hand side, Technical Analysis and Stock Market Profits. The other one is Technical Analysis of Stock Trends, Edwards and McGee.
Speaking of the obvious positions, real quick, Axel, this is a kind reminder to everybody that the obvious position, the obvious go-to place position that you need to have, dear listeners and viewers, on your following list is Aksel Kibar CMT, right? So make sure you give yourself a chance to actually understand chart pattern recognition so much more and so much better. This is literally the world-class analysis right in front of you, and it's being shared with you at no charge, right? This knowledge is worth millions and millions of dollars. This is something that some people would dare call, holy grail, even though holy grails do not really exist in trading. Still, this is the greatest value to have, Axel, definitely on your chart. On your chart list, whenever you think about charts, whenever you think about chart patterns, you definitely want to see and observe what Aksel Kibar CMT shares on his Twitter X profile, and you're gonna find him at Tech Charts, and please do yourselves a favor and go for it. Follow this gentleman, because what he's sharing is a billion-dollar solution. That's to say least. Please.
Now, thanks, Adrian. Bitcoin. Let's have a look at that. This is a weekly scale chart, okay? And the classical chart patterns, I always look at them in the context of overall price action. So this is like, I'm going to use a fishing analogy. And when you're fishing, there are different types of fish that you're after. Some are deep, some are a little bit at the top of the sea that you want to catch. They swim closer to the surface. The others are at the bottom. Some are close to the sand, some are close to the rocks. So you need to know what you're looking for, where the chart pattern is forming. In the case of a Bitcoin price chart, when we have peaked around 65K, and then we broke down that 28.6 horizontal line, the price came, I had a price target of 13,000, and we reached very close to that, around 15,000. And the price stopped going down further, okay? So the first rebound that came raised the question if we might be forming a bottom reversal here, because after an extended downtrend like that, you want to see bottom reversal chart patterns. So when I was analyzing this for my audience on our website, I have said so far a higher low, I said a higher low here would be analyzed as the beginning of a trend reversal. A higher low here. So this is a low and another low. But if the price can form a higher low here, it can form the left shoulder, head, right shoulder, which is a higher low, right shoulder. And it could be the beginning of a trend reversal. Head and shoulder bottom is a bullish reversal chart pattern. So it can take several weeks for the price to form the right shoulder in a wide consolidation between 18,000, because I want to see symmetry between the shoulders, and 25,000. So far we have seen 25,000 acting as resistance, and price has been pulling back. A deep correction towards 19,000 will still be in line with our analysis of a possible head and shoulder bottom reversal chart pattern. So a breakout above 25K will first face the strong resistance at 28.6 levels. So I'm saying that even a deep correction here towards 19,000, because of the symmetry, would still be okay. So this is basically the chart that we've been looking at the time. And that sharp correction took place in almost a week, took us all the way down close to 19,000 and closed at the highs. So we had that price symmetry and the horizontal boundary at 25K. The following week was a sweeping breakout. Now, this is your breakout confirmation, okay? With a long white candle. Sometimes it's green, depending on how you construct your charts. So after this breakout, I said the week starts right below the resistance, 28.6. You remember we said 28.6 was going to be a resistance. Support is at 25K. So now, once the resistance is broken, which is 25K, that becomes support. So support, resistance becomes support. The more price resists a sharp pullback towards 25K, the higher the chances of a breakout and targeting 34K. Now, we are able to calculate a head and shoulder price target, left shoulder, head, right shoulder. We take the depth of the chart pattern from the head to the neckline and add it to the breakout point, which gives us the head and shoulder price target at 34K. So we're saying that if the price can manage to stay above 25K, we will target 34K. That's the possibility of a head and shoulder bottom reversal. So that breakout now is followed by week by week with the consolidation above 25K. Now, head and shoulder price target is standing at 34K, but the price is not able to reach there. During this time, I'm getting a lot of questions saying that, is it possible that the price cannot rally to the price target? Yes, it is possible. So my answer is this: if it is not broken, don't try to fix it. So if the chart pattern is completed and your neckline is holding, you just have to be patient. You have your stop losses below 25K, little bit wider, little bit tighter, depending on your risk profile. But as long as the price is holding that level, you're good. So here, be it equities or FX crypto markets, are not in a rush to rally and reach price targets. It is testing patience and discipline. 25K continues to act as support. Price target stands at 34K. Bitcoin is in the middle of its move after the completion of head and shoulder bottom. So far, price held, and now we're testing 25K. Week after week, the support is holding, and we're rebounding from there. Now, this is really testing the patience. Now, so far, when you look at this price chart, the head and shoulder bottom completed, and we have seen a nice pullback. An ideal condition is for the price to continue. But the market is not ready. So 31.4K becomes our resistance, right? So now we have a boundary that we can depend on. What does that mean? Given that price is resisting to breach 31.4K, the next time it breaches 31.4K could become a fresh new buy signal for those who missed the breakout signal at 25K breakout. But the market takes its time and tests that 25K one more time. Now, guess what's happening here? Those who missed the opportunity to enter at 25K are stepping in, and that is helping the price to hold at 25K one more time, and then it's picking up. Now we have a well-defined lower boundary at 25K and a well-defined upper boundary at 31.4K, which becomes a rectangle above the year-long average. Now, this is the best setup that you can experience because, first of all, the head and shoulder completed. Following that, you have a nice sideways consolidation that the rectangle setup is ready. This could have broken on the downside. We were prepared for that because if it broke down on the downside, rectangle can be traded from the short side. You were going to be falling below the 200-day, below the year-long average, 365-day average, and that could have been a bearish signal. But given that we held the 25K, things were okay. At this point, we are ready for a breakout higher. And now we have two price targets. One is that 34K head and shoulder price target, and the other one is 38K. Now a fresh new price target is derived from the rectangle pattern. So things are improving now. What you want to see in an uptrend is the price to stabilize above its year-long average, which is the case. Now here, another note I wrote, Bitcoin starts the week strong with possibly targeting 31.4K resistance. There are two chart patterns in focus, already completed head and shoulder bottom reversal and possible rectangle that can complete with a breakout above 31.4K and the price target of 38K. Now the next week, the breakout takes place. This is the breakout that would take us to 38K. And now we're almost close to that level. We've came very close to it. I would say that the price target is reached. Now, what do we have here? I think we have a developing uptrend that can resume higher. From a classical charting perspective, I don't have a price target at this point because the two price targets that I have calculated are achieved. But an ideal way to track the trend is with trend following tools. One of them is a moving average. The other one can be an ATR based trailing stops that you can trail the move as the price goes up. Given that we are above 28.6, now the range is from 28.6 all the way to 65K. So if this trend develops, the next resistance we're going to face is around 65K. Let's have a look at a couple of charts that I've shared with my audience. ETH, a channel broke out on the upside, 18,860, pulled back, found resistance at 2143, the minor high. Now, you see, this is the diagonal pattern we're talking about. The concern with diagonal patterns is that the minute that the breakout takes place, you have an immediate resistance at the minor high, which is the case. So we are finding resistance at the minor high. The pullback took place. The channel price target is at 2,260. Now, from a weekly perspective, we have a rising wedge. It's not my favorite chart pattern to analyze, but I had to put it there because we have an upper boundary that can act as resistance, which is overlapping with the channel price target at 2,260. So the price can find resistance around that level if we clear 2143 levels. This is for the ETH. Link US dollar. This was a rectangle and head and shoulder bottom completing at the same time. So we had this perfect rectangle between 9.5 and 5.4, and inside that rectangle, we formed the left shoulder, head, and right shoulder. As you can see, there is a horizontal boundary at 8.5 and a horizontal boundary at 9.5. These are my favorite setups where you clear two chart patterns at the same time, giving you a clear, high conviction breakout signal. So when we're looking at those charts, I want to stress the importance of looking at those horizontal setups, be it on weekly and daily scale. I'm not very much interested in the intraday price actions, but with weekly and daily, you really get a clear picture and actionable conditions if you focus on those horizontal boundaries that are setting up and breaking out on the upside or on the downside. The next one is a fresh breakout, PYR US dollar, another rectangle bottom reversal. Yes, rectangle can act as a bottom reversal as well. So what you do is with the upward breaks, you take the depth of the chart pattern and add it to the breakout point for price targets. With downward breaks, to avoid negative numbers, you take percentage change. So if this was to break on the downside, you would need to take the percentage change. Let's say this is a 50% or 100% range, and you subtract that 100% range from the lower boundary. Because if you take absolute prices, you find yourself in you can find yourself in negative numbers. Now we have another setup here that hasn't broken out yet, but it's one of my favorite. 1, 2, 3, 4 touch points on the downside, 1, 2, 3 touch points on the upside. So if a breakout takes place above 8.7, it can really run fast, reaching 13.3 initially as the price target. I also have a rectangle price target at the bottom, 1.37. And if it fails and goes back to the 3.5 level, then I will start focusing on this target. So as you can see, I don't have a directional bias. I just want to identify those well-defined boundaries and act at the time of the breakout. That's all we can do with those classical chart patterns. Forecasting and predicting can put a bias, can put expectations on our trading, and if it doesn't happen, sometimes we might freeze. We might not be able to take action. So the best way is to remove that bias and look at both possibilities. But while you're doing that, make sure that the levels that you're going to act are the levels that are recognized by market participants. And that can only show up on the price as valid support and resistance levels, which are several times tested and proven by the market that the market have recognized this level. So for me, 8.7 is one of those. Another chart here is JST US dollar, another rectangle, and we're testing the upper side of that range. And if this thing breaks out on the upside, a quick move towards 0.054. Now, this is a beautiful chart that I've featured as an ascending triangle breakout. The reason is that in a steady uptrend, as the uptrend develops, you start seeing more and more bullish chart patterns completing that basically builds up the momentum, builds up the upward momentum. So this is one of them. INJ US dollar. You can see how the price reversed with a double bottom, 2 times test, neckline, breakout, pullback, rally, and then forming that ascending triangle. Now, ascending triangle is a bullish chart pattern. If you see it forming at the bottom or in the middle of a price chart, it's a bullish chart pattern. Reason for that is you have sellers at the same level, whereas buyers keep on bidding the price higher. So ideally, reversing from 10, price should have reached 5 support level, but it didn't. It found support at 6.5, meaning buyers were impatient. Buyers stepped in earlier to bid the price higher. So that impatience shows their strength to be able to push the price higher. And that gives us a directional bias. But still, it is the best to wait for that breakout confirmation to take place. Now, a similar ascending triangle formed on a ripple pair. This time, it was at the bottom of a price chart, which was again giving us a bullish perspective. This was a 2-month long ascending triangle on the daily price chart. So you can see the horizontal boundary and you can see the lows picking up. So it's not forming a rectangle here, but it's forming an ascending triangle with higher lows. And 0.56 was broken on the upside, and the price rallied, the pair rallied to 69 price target. The depth of the chart pattern at the widest point is added to the breakout level to get a price target calculation. Another chart that I'm looking at right now is LTC. Litecoin formed a left shoulder, head, and then a right shoulder. The neckline is at 70. Breakout, pullback, and likely to be followed by continuation towards the head and shoulder bottom price target at 80. So stops are below 70. And as long as we hold above that, you're good to go with this chart pattern towards the price objective. Now, let me go back to that double bottom so you can relate to the chart that I'm looking at here, ILV US dollar. This double bottom, I want to draw your attention here. So first test and second test on INJ, the neckline, breakout. Now let's go back to the ILV chart. First test, second test, the neckline. So the same pattern can repeat here as well. If we can clear that 103.5 levels on the upside with the price target of 170. Earlier, the pair cleared a similar bottom reversal here with the horizontal boundary and rallied to the neckline on the upside. So this can actually act as a nice reversal pattern as well. So this finalizes the presentation that I wanted to share with you guys. Adrian, what shall we do? Are there questions, or you want to take the lead?
Oh man. So everybody, speaking after Aksel is very difficult, right? because whenever Aksel speaks up, I feel this tiny little, right? I feel like I know nothing.
No, come on, Adrian.
No, I really mean it, man. I mean, this is such an incredible piece of work. One thing that I definitely took away for myself, I kind of like, never paid too much attention to the downside targets for those patterns that you said, would actually acquire the negative price targets, right? And somehow I kind of like, whenever I saw this in the past, in the past charts, and I would just kind of like ignore this or just basically, undermine, like downgrade, kind of like I would switch my attention from this chart setup, right? Because I would say, like, the negative prices are off, right? I think we can agree. Still, I couldn't find any sort of like a reliable price target, and then you're coming up with this excellent excellent hot tip for our audience, saying that you can take literally the percentage change and measure it from the bottom of the break, from the bottom of the pattern, right? So this is an excellent takeaway. I'm actually writing down a lot of those myself. And you're very right. So the community, the audience is actually hyping up. There are a lot of comments. There are a lot of questions. So if you don't mind, because we have a couple of points on the agenda, so still having about 10, 30 minutes left or so.
Yeah.
Would you mind answering one or two questions?
Sure, of course. Regarding
Excellent.
the percentage change, let me add on that, because that's an interesting one. The percentage change on the downside with downward breaks, and absolute performance, absolute price change on the upside. So both these measurements gives you conservative price targets, which is good, because you can always let it ride past the price target, but to prepare yourself for a more conservative price target is always better.
Higher probability. Yeah.
Yeah.
Higher probability. That's an excellent tip. By the way, so you've mentioned that you always take only the absolute, never the percent change when there's an upward breakout. Is that right?
Yes. On the upside, it's absolute price change added to the breakout point.
So how about if I put myself in the shoes, let's say, of a beginner, right, of a person who's a newcomer who just joined crypto, and the question that they often that I would ask myself, like, there is this arithmetical scale and there's a logarithmic scale, right? So does that even because the logarithmic scale, of course, the higher it goes, the bigger the difference is within the same distance, let's say visually on the price chart. So on the logarithmic chart, for those high price assets like Bitcoin, for instance, right? When you also like close it to $40,000, and the higher it goes, the distance kind of like just keeps the same, but the you just add new zeros, let's say. So how would you build the price targets on the logarithmic chart of a high price asset like Bitcoin, the higher it goes?
First of all the charts that I've shared or I use are log scale. Okay, let me go to some of the charts to talk from the slides. For example, let's see this one. Okay, doesn't need to be a big digit number. So, for example, you see XVS US dollar, and the distance here is so small compared to the distance on the downside. That's because I'm looking at a log scale price chart, on the log scale price chart, okay? So when you look at it on a log scale price chart, it actually helps you analyze the long-term price chart. But when you go to the level and you see that, okay, the level is 8.7 and this level is 3.5, I take the difference and add it to the breakout point, it gives me 13.3. So the price target calculation is very straightforward. And then you take the percentage change here. Almost all trading softwares have the percentage change distance and subtracting it from the breakdown level, which gives you 1.37. But the chart is not messed up with the linear scale, because linear scale will not allow you to analyze long-term trends. You will not be able to see multi-month price action on a linear chart.
That's right. Try displaying Bitcoin charts since 2011, right? On linear chart.
Yeah. So
that's a complete sense. Yeah.
Yeah.
So real quick, right? So we also had the excellent question. This is a great answer, and again, a huge shout out. Not sure, guys, you guys have seen how many slides Aksel have prepared for you. This is mind blowing and incredible value, and there's so many beautiful comments, full of appreciation for what you do, Aksel. And kind reminder, you can follow Aksel on Twitter, and I actually encourage you to do it. To follow Aksel Kibar CMT at Tech Charts. This must be one of the best decisions to ever follow Aksel. It was for myself, and the quality speaks for itself, everybody. So another question real quick, Aksel, before we kind of like narrow to one last point on the agenda. There was a question, very interesting one, a very interesting one about the time frames, right? Even though you've mentioned that you mainly favor, the daily and the weekly time frames, which makes complete sense, of course, for extracting those long-term patterns and long-term trends. My kind of like response, my response to this question in the chat was that the whole beauty of technical analysis and time frames are that they are fractals, right? Which means that what you're sharing is by the book universal, right? You can find the same patterns and the way that they resolve on a daily time frame, on a weekly chart, on 15-minute candles, on 1-minute candles, and so on. Knowing still, of course, that there is some more randomness. And in the lower time frames, there's more chaos, more entropy, more of those complete random walks, if you will. Still, what would you say? Like, have you noticed anything specific about a daily chart that is going to always make you pick the daily chart over, let's say, 5-minute chart?
Okay, so here is the logic behind mostly favoring daily and weekly scale price charts. Now, when you look at those Schabacher's, Edwards and McGee's books, you will see that the daily charts that they have used in those days, okay, are very close to the weekly charts of today's. What does that mean? That means the volatility, the involvement, the volumes are increasing and the swings are becoming wider and wider in today's markets. Okay. So you need to step back a little bit to go back to those days of inefficiencies to be able to find those uninterrupted trends. You need to step back a little bit. That's one of the reasons that I like to focus a little bit longer term. And the other reason is that we traders, investors, whatever we name ourselves, this is now, we're talking about the liberating impact of our business is to be able to let the computers do the job, or not needing to sit in front of the computer and babysit positions. So I always ask myself this question: why do I need to be a slave of that screen intraday when I can actually capture a little bit longer term trends and in the end be more healthy and could translate into being a little bit more wealthy because without health there is no wealth. So the longer you sit in front of that computer, the more knee-jerk reactions you will have, the more the less time you will have for your other daily tasks. In fact, the other day I shared something because this is a common question also. I feel like part-time traders have a better edge in markets than full-time traders. Full-time traders will be bombarded with constant news flow and constant self-doubt of their portfolio positioning and their account values and so on, versus the part-time trader can easily switch off the screen, let the computer do the decisions, orders are placed and so on, and focus on other things to clear his or her mind and come back and see at the end of the day what happened, because that's what matters. The end of day closing values will matter the most, or end of week closing value will matter the most. And sometimes intraday there's so much news flow that we really don't need to be there. We really don't need to be involved in that time frame.
I love the response. And quick medical caution: this is what happens when you spend too much time in front of the screens. Don't do it.
I lost my bag. My hair is still there, but my bag is gone. So
Oh man, it sucks, right? It sucks. We are all getting older, man. I just turned 30, by the way, right? And I feel immediately what you're saying about the back. It's crazy. Still, I mean, this is such a wealth and generosity of knowledge that Axel has shared with us, everybody. I'm learning, right? There's so much that I learn, and like I said, I love speaking with Axel because anytime we go on a live session, I feel so little. Right? It is like mind blowing how much I do not know and how much Axel possesses in terms of the knowledge, incredible knowledge, and I really mean it. It is actually worth, well, the lifetime opportunity is worth the lifetime money. It is worth millions and millions of dollars. That knowledge that Axel is sharing is reliable. It is accredited. It is quantified. It is evidence based. It is not some set of random squiggle lines and trying to incorporate our feelings, what we fear, what we desire, for the charts. This is truest example of technical analysis. And Aksel Kibar, CMT, ladies and gentlemen, is the world's leading expert. And to me, Axel is number one. So do please make sure you follow Axel again at Tech Charts. He's displaying right now www.techcharts.net, Tech Charts on Twitter, Tech Charts on YouTube, and you know well why it is Tech Charts, technical analysis, charts, chart pattern recognitions. this is the incredible niche that Aksel has taken us for the journey with. So one last thing, Aksel, before we disconnect in about a minute or so, what's the final tip that you love to leave our listeners and viewers with regarding classical charting and chart patterns?
I always give this tip to traders who are involved in speculative assets. We hop from one methodology to another, and I call that style drift. And you start questioning when times get tough and some patterns do not work, and you start looking for other methods at a time when things start working. And then you look back and you realize that you've lost a couple of years hopping from one methodology to another. My tip is to stick with something that is working, that has an edge, slight edge, with proper risk management, proper sizing, and so on. You can make it work in the long run if you stick to it. It's like basically having a tool that you master that craft, you master how to use it to a point where you can navigate through difficult times as well, with a little bit more portfolio structuring, sizing down, and stepping back a little bit. You can pass through those times with less damage, but when the times are ripe, you will be able to see the benefits of mastering that craft and enjoying the returns.
100%. That is a golden tip. Persistence, consistency, and compounding effect is what is actually going to help you make it. Ladies and gentlemen, Aksel Kibar, CMT, excellent world-class expert at chart pattern, classical charting, and privately my good friend that I'm honored to learn so much from every single day by observing his Twitter and, getting access to this incredible wealth of knowledge from the Free Trading Congress. Ladies and gentlemen, thank you so much for watching. Aksel, you are the legend. Thank you so much for your time.
Thanks, Adrian. Thank you, everyone, for joining. Have a good day.
Thank you so much. Roll on to the next session, which is starting right in a minute. Thank you so much.